As you all know, the tax year 5th of April is approaching, and many of my clients wants to know the merits and demerits of putting money into pension or ISA. They both have their own tax advantages and disadvantages. If you also want to know the same, then please watch this video. Hi, my name is Gagan from 121 Accountants. My mission is to empower individuals and businesses with knowledge and service to help them achieve their financial goals. Pension versus ISA. These are the two investment vehicles, and they both have their own advantages and disadvantages from the tax perspective and the cash flow perspective. In this video, we'll cover the following topics. What is ISA? What is pension? What advantages and disadvantages of ISA? Advantages and disadvantages of pension. What is ISA? ISA is an individual saving account. There are three types of ISAs. One is cash ISA, stock and share ISA, and lifetime ISA. Any income and gains earned in ISA account are tax exempt. So if you put money in cash ISA, any interest you are earning, or if you are holding a share in stock in a stock ISA, any dividends you are getting from those stock and shares, or any capital gains when you sell these shares are all tax exempt. Likewise, in lifetime ISA, either you can hold money in cash or you can also invest the money in stock and shares. Cash ISA can be open once you reach the age of 16. Stock and share ISA can only be open when you are 18 years and above. Likewise, lifetime ISA can be open when you are 18 years or above, but you can only open a lifetime ISA between the age of 18 and 40. So if you're above 40, you cannot open a lifetime ISA. Lifetime ISA, you can only withdraw money when you are going to buy your first home or later at the age of 60 when you retire. In lifetime ISA, you can only contribute up to £4,000. 25% of the bonus will be contributed by the government up to £1,000 into your lifetime ISA account. But after 50 years of age, you cannot contribute into a lifetime ISA account. But whatever money you are holding into lifetime ISA account, still that will get an interest or any gains it has. But lifetime ISA, you can only withdraw money after 60 years or if you are buying a first home. But in other ISA account, the limit is £20,000. So the total limit of any type of ISA is £20,000. But in lifetime ISA, you can only contribute up to £4,000, which is also a part of your £20,000 allowance. Let's talk about pension now. So what is pension? Pension is also an investment vehicle where you park the money for a long term for your retirement. So in pension, if you contribute money to pension account, you get a tax relief on an investment. So once you put the money to pension pot, you will get a 20% or a 40% or a 45%, whatever tax bracket you are, you get a tax relief on that. If we talk about contributions into pension account, so you can contribute greater of 3,600 or individual relevant UK earning. What that means is UK relevant earning is that earned income. So let's say your salary is £40,000, so you can contribute up to £40,000 into your pension pot. Or if you're not working at all, still you can contribute up to £2,880 net, where government will top up by 20%. So 3,600 still you can save into pension if you are not earning or you don't have any relevant income into the UK. Relevant income means earned income like employment income or self-employment income, but rental income or dividend income are not earned income. Maximum you can contribute into pension is each year is £40,000 plus any unused allowances from the last 3 years. So total contribution you can make each year is £40,000. That includes the employer and the employee contribution both. What that means is that if a pension scheme is provided by your employer, where employer is also contributing into your pension pot, that also become part of your allowance of £40,000. Let's talk about advantages of ISA. So what are the advantages of ISA? So far we know that is an individual saving account where any income and gains are tax free, but there are other advantages as well. So like any income and gains earned into ISA account are tax free. Let's understand this again. So if you put £20,000 into a cash ISA account, and after a year you have earned an interest on that cash ISA account, that interest will not be subject to any tax. Likewise, if you invested the same money of £20,000 into your stock and shares, and then you are getting a dividend on the stock and shares, or if you sell some shares, you made a gain on that, that gain or dividend will also be not subject to any tax. They are tax exempt. You can invest either in cash or in stock. The investment limit is £20,000. So you can only invest up to £20,000 each tax year, which runs from 6th of April to 5th of April every year. But you cannot contribute more than that. Or if you don't invest anything this year, that allowance cannot be carried forward either. The biggest advantage ISA gives is the flexibility. You can withdraw your funds whenever you want. So there is no boundaries or foundation. Anytime you can withdraw your funds. It's very flexible. The flexibility, if you're looking for a flexibility for your investment or accessibility of your funds, then ISA is the best option. The advantages of ISA, the disadvantages of ISA. So the disadvantages are that whatever money you're going to invest will be your tax paid money. So you will pay tax first on your money, and then whatever take from your take home pay, you will put the money into ISA account. So there are no tax savings on investment, but there are tax savings when there are any income and gains generated by that investment. The second disadvantage is that this ISA becomes the part of a death estate, and inheritance tax is also applicable on that. So IST is payable on the pot of ISA, which will be left by a deceased person to his beneficiaries. Lifetime ISA has only a limit of £4,000 a year, so you can only contribute up to £4,000 into lifetime ISA pot. You cannot contribute more than that. And the total ISA limit is £20,000, which includes the £4,000 lifetime ISA limit. So if you have a lifetime ISA account, so £4,000 you can put in lifetime ISA account, and £16,000 you can put in other cash or stock and share ISA account. So total limit is £20,000, and lifetime ISA allowance limit is only £4,000. Unused limit or unused allowance cannot be carried forward into your cannot be carried forward into next year. So let's say if you have not saved or you have not put anything into ISA this year, that limit cannot be carried forward. So these are the main disadvantages of ISA account. So now let's talk about advantage of pension. So we know that pension is a vehicle where you put money in, you get a tax relief, but there are other advantages as well. So first is you get an immediate tax relief. So once you put money into pension pot, there are 2-3 ways to put into money into pension pot. One, you contribute money from your take home pay or your tax paid money. When you put the money into pension pot, the government will top up by 20%, and if you're a higher taxpayer, the difference of 20% is you get a tax claim through your tax return. The other way is that your employer also contribute into your pension pot. So for example, that if you are contributing 10% of your pay and your employer is contributing 3% or 5%, that also adds up into your pension contribution. So there is an immediate tax relief on the pension contribution. Invest in cash, stock and shares. So again, when you put money to pension pot, you have a choice to leave it as a cash, or you can invest into stock and shares. You can contribute up to £40,000. So annual allowance is £40,000. Plus, if you have any unused allowances from the last 3 years, you can use that as well into pension contribution. But that £40,000 allowance includes your employer and employee contribution. So both contribution, total contribution is up to £40,000 you can make into your pension pot. Either you contributed or your employer contributed. So total contribution is £40,000 plus any unused allowances from the last 3 years can be carried forward. Net contribution of £2,880, and an individual who don't have any earned income, still he can contribute £2,880 into the pension pot and 20% will be topped up by the government into a pot. That's very good strategy for a child. So if a parent want to save money for their children, they can open their children pension account. You might be thinking I'm talking about children pension. Yes, you put the money now and they will access that money when they are age 55 or 57, whatever the age limit will be at that time. It's a very long term planning, but you have to only put £2,880 a year or less, whatever money you put in. 20% government will contribute into that. So total money invested will be your contribution plus government 20% top up. So total investment, total contribution you can make is 3,800 gross, including government 20% contribution. So any individual or a child who don't have any income, still they can put the money into a pension pot and take the advantage of 20% government contribution up to £2,880 net contribution. Now the another advantage is that if you are contributing into a pension pot through your employer and your employer runs a salary sacrifice scheme, in that case you will save a national insurance as well. So for example, your salary is £30,000 a year and your employer said that we'll give you a £10,000 bonus at the end of the year. So taking the bonus through your payroll, if you ask your employer if they put that money directly into your pension pot, then you will save a national insurance as well, plus the tax as well on that £10,000 contribution. And your employer will also save the employer NI, which you can obviously ask your employer to share, or he can also, if he's very generous, he can also contribute that amount into your pension pot as well. But there are options. So if you contribute through a salary sacrifice scheme, there is a national insurance advantage as well. 25% of the pot value when you hit the retirement age of 55 currently to withdraw pension pot, if you hit that age, 25% of the pot you can withdraw tax free. So 25% of the pot value you can withdraw tax free, but rest is taxable. Again, when you can pass this into your inheritance tax free. So whoever inherits your estate, this pot will not become a part of death estate and there will be no IST tax on that. But there are other rules as well for IST if somebody dies before 75 and after 75 and on the withdrawal. You can read that in detail on gov.uk website where there are other rules for IST on pension as well. But in generally speaking, IST, there is no IST on the inheritance of pension pot. Let's talk about now disadvantages of pension. There are some disadvantages as well to the pension. The biggest disadvantage is that your money is locked at the age of unless you reach 55. So if you're contributing at a very young age of 20 or 25, you would have no access to that money till the age of 55, and this limit is going to increase to 57 from 2028. So you have no access to the money. So that's the biggest disadvantage. So if you're saving for a short term, then this is not a very good vehicle because you have no access of the money once you put into your SIP account or your pension pot. You can only withdraw 25% of the pot tax free, but rest will be taxable when you withdraw at the age of 55 or 57. When you withdraw this money, you have to pay tax on that. Contribution up to 40,000. So you can only contribute up to 40,000. You cannot contribute more than that. If you contribute more than that, there is a pension charge is applicable. So if you accidentally contribute more than £40,000 into your pension pot, then you have to pay a marginal rate of tax on that. This is called pension charge. And if your income is above, if your threshold income is more than £200,000 and your adjusted income is £240,000, then your annual allowance of 40,000 will reduce. So how they will reduce? So for every £2 your adjusted income goes over £240,000, your annual allowance for the current tax year reduced by £1. So if you are an additional rate taxpayer where your income is above £240,000 or your threshold income is over £200,000, then be mindful before contribution, because your threshold allowance, your annual allowance will reduce by £1 for every £2 of your adjusted income goes over £240,000. So these are the disadvantages of pension. So far we have looked into advantages and disadvantages of pension. Here I'm not going to give any decision which is good or bad. It depends on an individual circumstances. For some the ISA will be better, for some the pension will be better, because obviously if you're saving for a long term, then pension is better. If you're saving for a short term, then ISA is better. And then obviously if you're looking to leave inheritance for your kids, then pension is better. Obviously if you're living, then ISA is subject to IST. So they both have their own advantages or disadvantages, or merits or demerits. So obviously discuss with your financial planner, discuss with the family what's your financial needs are, then accordingly take a decision. And there's another advantage on the pension contribution, is that if you are a earner between 50,000 60,000, if you put that money into your pension from 50 to 60, if you put that 10,000 into your pension, then you won't be paying then you don't need to pay a high income child benefit charge, because when you put the money into pension, that reduces your relevant taxable income from 60 to 50, so you will save a high income child benefit charge on the on that amount. So again, they are it's a very vast topic. Pension and ISA, they both are good and they both are not good, depending on your personal need and circumstances. And thank you for watching this video. Please don't forget to like, subscribe and share my channel. Thank you once again for watching.